Good morning, friends. It's indeed pleasure that at ICI, Direct Taxation Committee, International Taxation Committee, and Committee relating to GST and indirect taxes is pleased to join you for presentation on finance bill particularly. As you are aware that the finance bill contains various provisions relating to international taxation, relating to domestic taxation. Earlier, it used to have provisions relating to indirect taxes as well. However, now, since this particular power has been vested with GST Council, we don't find much provisions relating to GST. However, friends, as far as these provisions relating to direct taxes or indirect taxes are concerned, they take some time for the purpose of taking effect. In the meanwhile, people try to comprehend. But one thing is there, what instantaneously reacts is the stock market. And as a chartered accountants, we are also interested in making investments. Clients also keep us asking, the stakeholders keep us asking that, okay, what is the impact of the budget on general economy and how the share market will function, how the investments would grow. So all these things are also there in store, which have impact as far as this presentation of union budget is concerned. So friends, we have invited various experts from the field. We have with us Honorable CA Anand Ratiji, who is expert in the field of capital markets. So he will be telling us about how this particular union budget will have impact on capital markets relating to GST and indirect taxes. Although there are no much provisions, still we need to understand some significant provisions. So Vice Chairman of WIRC, CA Yashwant Kasar, has also joined. He will explain us briefly those provisions. In respect of international taxation, we have with us the former chairman and council member of this particular committee relating to international taxation, CA NC Hegde, who is also expert in the field. So he will be informing us what are various changes as far as this field is concerned. And of course, the domestic tax provisions, there are a number of them, some are significant. We have with us former president of our institute, CA Nihar Jambusariya ji, who will be dealing with those provisions. I have also with us chairman of International Taxation Committee, CA Sanjay Kumar Agarwal, chairman of GST and Indirect Taxes Committee, CA Rajendra Kumar P, and also CA Hansraj Chukji, relating to corporate matters, relating to committee on public members in public service, and vice chairman of Direct Taxation Committee, CA Raj Chawla, has joined from Dubai. So I welcome all of you, the speakers and my chairman of other committees. So friends, let us start with our discussions. The flow of events would be: first, we will be having briefly the information about the GST and indirect taxes provisions. Then we would invite CA Anand Ratiji to explain the impact of union budget on capital market. Then CA NC Hegde will talk about the international tax provisions. And lastly, CA Nihar Jambusariya ji will tell us about the domestic tax provision. So friends, with this brief introduction, let us start the discussion. As you are aware that this is the last budget before the next parliamentary elections, so much goodies were expected by the taxpayers and by one and all. But credit should be given to the finance minister for this financial discipline, that not much offerings have been made. Whatever are within the limited framework, the offerings have been made. And particularly, the deficit has been contained to 5.9% of the GDP. And this will definitely have a long-term positive impact. We see the economies of our neighboring countries, where number of offerings were made and ultimately those economies went into doldrums. So we are very happy that this financial prudence have prevailed with the finance minister, and we will certainly marching the path of progress. So friends, coming to the first segment relating to GST and indirect taxes, we will be having CA Yashwant Kasar informing us the provision. But before that, let me invite Chairman GST and Indirect Taxes Committee, CA Rajendra Kumar P, for his opening remarks, and then we will go to CA Yashwant Kasar. Over to you.
Thank you, Chairman of Direct Taxes Committee, CA Chandrasekhar Chitale sir. Very esteemed past president of ICI, CA Nihar Jambusariya ji, who is decorating the dais here. Sanjay Agarwal ji, my very good friend NC Hegde ji, council colleague Hansraj Chuksa, and Raj Chawla ji online, Anand Rathi ji, and all other esteemed members who are present online. A good morning to all of you. A day of budget has passed, discussions galore, interpretations numerous, and doubts in the minds of very many members getting accumulated day by day. I restrict my thoughts to the committee of which I am the chairman, the GST and indirect taxes. If any of you have closely followed the GST council meetings, any of you have closely read the minutes of the GST council meetings, then there is no secret about this budget. In fact, there's no secret now left for the budget, any budget per se, for the GST matters in particular, because nothing can be introduced in the budget, no amendment can be made without the formal approval of the GST council. Be that as it may, 12 clauses have been amended in the Act, CGST Act, and pursuantly the SGST Act also the amendments will carry forward. There are 2 amendments which are made in the IGST. In fact, I would say that this budget has very pointedly referred to a very, very important aspect. Schedule 3. Schedule 3 of the CGST Act is a section, is a schedule whereby something is not a supply, something is not a supply of service, nor supply of goods, which means it is the outside the ambit of the Act itself. Now, there have been confusions, there have been talks about taxability of high seas sales and its margin and so on and so forth. The relevant provisions of the Schedule 3 have been amended to say that it will be exempted. But if someone has paid the tax, but this amendment comes with retrospective effect, July 1, 2017. But very clearly they say that if you have paid the tax, if someone has gone voluntarily and patriotically paid the tax, the government very clearly has clarified, please don't ask me for refund. Very clearly they say no refunds will be there as far as this provision is concerned. And one more aspect, 17, section 17, subsection 5 has been amended. A new clause is introduced whereby the input tax credit on CSR expenditure is blocked. It's a blocked credit. Now, all amendments in the GST will be implemented only from the date they are notified. And from the date of their notification, only they take effect. Now, you will be thinking, what happens to this? Is it retrospective? It is prospective. In fact, I would not deviate on that. We have many other speakers who are going to speak on so many topics. We have a full-length session on the GST also. But I would only say one thing, my friends. Each GST council meeting is a budget for GST and indirect taxes. Maybe not for customs, but customs, yes, here and there, rate changes have been made. No policy changes, not major amendments. Only thing is the time limit within which the settlement commission has to decide on an application has been fixed as 9 months. So with these brief opening remarks, and with not much of hue and cry over the budget as far as the GST and indirect taxes is concerned, I thank the organizers, particularly my good friend Chandrasekhar Chitaleji, for giving us the opening opportunity, because as Finance Minister always says, now I turn my talk to the tax proposals, indirect taxes. Thank you very much, Chitale sir, for giving us that honor. And may I request Yashwant Kasarji, who is there online, to please give his presentation on this very important area of indirect taxes. Thank you very much.
Thank you.
Thank you, Rajendra Kumar sir.
What do you want to say?
I first of all thanks the direct tax.
You are on mute.
I first of all thanks. Am I audible, sir?
Yashwant, you're on mute. We can't hear you.
Sir, I am audible. Am I audible, sir? Am I audible, sir, now?
We are able to hear, but I think the
Sir, am I audible now? Sir, am I audible?
I think they have, I think those who are listening are able to hear you, Yaswant. I think wait for them to, I think they're checking something at their end. Eh? Just wait, please. Eh?
Okay, sir. Sir, am I audible? Sir, आवाज मला. Okay, okay. So, good morning, friends. First of all, I thank the Direct Tax Committee of ICI for giving me chance to present before you the budget provisions in indirect tax, specifically GST. I thank all the dignitaries present over here. Friends, as Rajendra Kumar sir said, in the budget 2023, the provisions related to GST are not much, but some important provisions they have provided, important aspects they have provided in the budget. In my presentation, in a short time, I will try to cover and touch those changes related to GST in this budget. Is my presentation visible to all of you?
Yes.
Yes, sir. So I have divided the budget changes in GST in two parts, some critical changes and other changes. If we say what are the critical changes in this, or the important changes in this budget related to GST, then the first thing is they have increased the reversal of ITC scope, and now the ITC on goods and services received for performing CSR activities will not be available as ITC, and this may add to the cost of non-profit organizations and these companies who are doing these CSR activities. So this is one of the big change. Although some of the interpretations, some of the professionals were of that view always, but now they have made it clear. And now because of this provision, there will be increased level of ITC in case of companies who are doing these CSR activities. Then the second important change is about high C sales, and the provision currently the para 7 and 8 of schedule 3 provides for supplies, for example high C sales outside the purview of GST, and this para 7 and 8 were introduced from 1/2/2019. Para 7 and 8 now it is made applicable retrospectively. However, if tax paid already, then refund is not permissible. And because of this, this may be beneficial for ongoing audits or cases where notices are issued. This change related to high C sales is there in the budget. Then pending returns can be filed only up to 3 years. At present, there is no specific outer limit on filing of GSTR 1, 3B, GSTR 9, GSTR 8, etc. But now the restrictions are proposed in this budget provisions on filing of returns to maximum period of 3 years from the due date of the respective return. So there may be some exceptions may be provided by GST Council, but now given the outer limit, these taxpayers will need to, all the taxpayers will need to file the returns well within time. The time barring provisions related to ITC availment are still there. These provisions are only related to filing of returns under GST. So there was no any time limit earlier. Now a prescribed time limit of 3 years is provided for all these kind of returns under GST. Then this is also one of the welcome provision in the budget related to higher limit for prosecution except for fake invoicing. Currently, for launching the prosecution under GST, the current threshold is 1 crore. For example, if the tax amount evaded is more than 1 crore, then the taxpayer can be jailed, prosecution can happen. But now this is proposed to be increased to INR 2 crores. So they have doubled this limit for prosecution. However, this increased limit is not applicable for fake or bogus invoicing cases. For these type of fake or bogus invoicing cases, the current limit of 1 crore only applicable. It may lead to the peace of mind of genuine taxpayers because the limit was less, and this is also one of the welcome step. Similarly, another important provision in the budget is related to decriminalization. So this act of preventing officers tampering evidences, non-supply of information will not be a criminal offense now. Earlier, because of this provision, many genuine taxpayers also faced hardship while undergoing the cases of the GST or the investigation phases. So this is also one of the welcome provision in this budget. So aforesaid change may result in better governance, and it will reduce the pressure on courts as well, because the lot of litigation can be avoided because of this provision. Then compounding charges also they have reduced. So the compounding charges means amount to be paid if you don't want to go jail and you want to compound that offense, and you are ready for that settlement. Now it is proposed to reduce the compounding charges from 25 to 100%. However, this change is not applicable, as I said, for the fake invoicing cases. For that, the limit also the same, 1 crore, and this compounding also not reduced, and that is not possible for this fake invoicing cases. So clearly the focus of the government seems more on the recovery and less on initiation of proceedings. They want to reduce the litigation under GST by introducing these provisions. Then one of the important provision is related to data, the information like registration details, GST return details, then invoice details, e-way bill, etc. Can be shared with the other systems, and for the data sharing, consent of the supplier and recipient is required, and what methodology they will use for this, it will be prescribed in due course. And further, government or the GST portals will not be held responsible for the information shared. So this provision they have made this in this budget by way of this budget provision. And data sharing may help. This data sharing may help the financial institutions to extend the credit to taxpayers, because they will be able to fetch all these details from the portal. Then no registration in case of entirely exempt supply. Currently also, if someone is involved in only supply of exempted goods or services, then there is no need of registration. But because of the other provisions of the compulsory registration, if he is availing some or procuring some goods or services where there is reverse charge applicable, in those cases, compulsory registration was required. So to just go do away with that hardship, and because of only that one event, registration was required. So now they have made the provision that if entire outward supply of the business, if it is exempt, then there is no registration requirement, even if there are some inward supplies of goods or services where RCM is applicable. So this is also one welcome provision in this budget. These were the important critical changes that they have made. Then regarding other changes, one change is related to point of supply in case of transport of goods to outside India. Currently, the proviso to section 12 subsection 8 states that a POS shall be the destination of goods in case of export of goods. Now, this proviso to be deleted, which signifies that POS shall be location of the recipient. So instead of destination of goods, now the location of the recipient. So earlier the white circular dated circular number 184/2022, it is already clarified that ITC is available, and this may be beneficial for the exporters now. Now, the level playing field for composition taxpayers in online and offline space. So currently, the composition taxpayers cannot supply goods through e-commerce operator if they are supplying goods or using services of e-commerce operator, then they were not able to avail this composition scheme. But now the composition taxpayer can make supply through of goods through e-commerce operator. However, the one important thing is this is not applicable for the service providers, and they may not be able for eligible for this above amendment. Actually, all the restaurant service providers, they are using the services of e-commerce operator, but this will not be applicable for them. Nevertheless, they are in normal scheme as well, because the rate of composition and the normal is same. So this will not make much impact, but for other service providers who are under composition, they will not be able to take benefit of this provision. Then e-commerce will be responsible for non-compliances on their platform. So now the e-commerce could be held liable for specified offenses such as allowing supply through unregistered persons, allowing interstate supply to an ineligible persons, or not furnishing correct details under Section 52. So this amendment will lead to increase in compliance burden for e-commerce operators, along with the risk of penal provisions. So the responsibility they have increased by way of this budget provision. And the changes related to OIDAR. Currently, they have expanded the scope of this definition of OIDAR and non-taxable online recipient. So they have expanded this the scope, and because there were multiple interpretations, and because of that, some litigation were prop up. So to avoid that, they have clarified and they have expanded the scope. So this will reduce the interpretation issues. And then the last is increase reversal of the ITC. So supply of warehouse goods before clearance for home consumption will now attract ITC reversal. This amendment will effectively mean sale of goods at duty-free shops at arrival terminal will now attract ITC reversal, and this may increase the cost at the duty-free shops. So friends, these were the important provisions related to indirect tax, although not much provisions they have introduced related to GST, because GST Council every now and then, whenever the council meeting happens, they introduce the changes. But by way of this finance bill, these provisions related to GST they have introduced in this budget. So friends, within a short span of time, within given time, I have tried to cover the provisions related to GST in this budget in short. So I once again thank the Direct Tax Committee of ICI for giving me chance to present these budget provisions before you. Thank you, sir.
For your quick reaction to this union budget relating to direct taxes. Friends, as far as stock markets is concerned, now each and every chartered accountant is interested in knowing the developments, how the union budget will impact the economy. That is the main cause of concern. And we have with us chartered accountants Anand Ratiji, who is expert in the field. He has also been on the council of the ICI, and I'm sure that his views will certainly add value to our discussions. So I request my colleague on the council, C.H. Chuk Saab, to just start this session relating to capital markets and union budget.
Yeah, thank you, Chitresh Saab, for your nice opportunity given to me. You see, like the stock market or the financial world, or we talk about the capital market, it has a very great impact once the budget comes in. For the many reasons, because budget, if goes forward and which brings out the best in the ecosystem or the economic development, naturally the response comes from the market accordingly. The important role, whether it is the development of the infrastructure or the development of a specific sector which is instrumental in bringing out good in the system of the country, always been responsibility of the government. The objective and purpose by which with the preamble, this budget has been brought in with a certain parameters, whether the demand and supply or the supply chain management, or the government spendings, or the agriculture boost how to be given with the innovative ideas, sector-specific promotions, implication to the corporate words. So many good things are there where our economic system is bound to make a difference. And today we are fortunate enough, uh, a gentleman everyone know with CA Anand Rathi ji having a large experience. I know for a very long when I was a student, uh, I was always been heard of the name which is really and having experience maybe odd 50 years experience in a diverse, whether it is the corporate words or into his own pitch into the financial market, bringing the best in the system. And he remained as a on the board of the become a president also of that very large stock exchange of the country. A very good experience. I'll not much deliberate upon because we all know him personally, many of us personally, and many of us by way of his acumen towards the financial market or the development of the system of the country. I'll straightway request him to share his words about the on the financial front, on the economic front, and on the many fronts which goes with hand holding with the or understanding better understanding of the budget in that very respect. Over to you, sir. Rathi Saab, over to you. Thank you.
Hmm. Thanks, Mr. Chog, and thanks, Mr. Chitle. Also, my thanks to the committee for inviting me for this presentation. It's always a pleasure to talk to fellow chartered accountants. I think I always have that passion that whenever there's an opportunity to talk to my fellow professionals, I would love to do it. Today, because I've been asked to share about my views on the union budget and its impact on the capital markets, I think, friends, as you are all aware, that, at the end of the day, all markets are affected by the macroeconomy of the country. And therefore, what I've done is make a small presentation of few slides to bring to you where do we stand today in terms of macroeconomy, and what is budget going to do to the various parts of our economy, and particularly also what budget is going to do the capital markets. As it is said that capital markets are indicator of the economy of any country, and therefore, but that's it absolutely true on a long-term basis. On day-to-day, friends, you all, I think many of you must have been involved in the share market transactions or any other way. You know it that in short term, the markets operate on sentiment and events. So budget is also an event. Many times it has a great impact on the market, but not necessarily. So I'll start. No? Are you able to see?
Yes, we can see your presentation.
Okay, great. So I'll take you through the presentation shortly. Uh, you know, so I think where do we stand today? I think it's really heartening for all of us to really recognize that today we are the fastest growing major economy, particularly in last 2 years, post pandemic, we have really started doing well, and thanks to government, RBI, and everyone who really pandemic time handled it very well, didn't go overboard on in spite of obviously criticism coming on that, but I think now, and also IMF expects that in next 4 5 years we should continue to be a fastest growing economy. My own view, friends, is that potential is great. With all my experience in the corporate sector, capital markets, everywhere, I can tell you that India and Indians, as Indians, and particularly chartered accountants who are the most brilliant, we can do very well, and we should be able to achieve a very high level of growth in next few years. Now, the biggest problem the world is facing today is inflation. And here again, I think thanks to our policies in last 2 3 years, our inflation has not gone up as it has gone up world over. You must all be obviously are fully aware that how the US inflation has got to highest levels in last 20 30 years, which they have never achieved. Europe is having higher levels of inflation, all the countries for that matter. But I think in our case, I think our inflation is controlled. And my personal view is that inflation is peaked out. And I think we are going to see lower and lower inflation. You have seen even US has recognized this. And last night, the Fed has increased their interest rate just by 25 basis points. So that shows that there is a reversal of inflation in the world. But in India, I think we are far better. Now, what are the positives for India before the budget even came, So I think our fixed investments have started increasing now. The investment cycle is changing. I think 2022, the announcements of the new projects made have been highest in last 8 10 years. We saw that there is now demand, and also the capacity utilization in all the industries is now increasing, and there is a need for new investments. And I think that's what we have started seeing just now. The private consumption also has increased, after, of course, big corrections in pandemic. But after that, I think we are becoming quite normal in private consumption. We'll see how the budget is going to affect all these, But I'm just telling where do we stand today. Our banking system is pretty robust. And I think, again, you might be aware that now the NPA levels are again lowest in last 10 15 years. Gross NPA at 5% is among the lowest. The government finances are again, I think, while we had fiscal deficit in last few years, but last year it was brought down to 6.4%, and it has been maintained as per the revised. And next year is obviously going to be reduced further to 5.9, and the finance minister has committed to bring it down to 4.5% in next 3 years. The PLA scheme which has come has really helped. I'm able to see. Are you able to see my slides? Hello, are my slides visible, please?
Your slides are visible.
Okay,
We are
fine.
able to see. Yes.
So, I think back. Yeah, I was on this slide. So the PLI scheme is again, I think, doing wonders, and we really appreciate the efforts of government in this direction, because if we have to become a global manufacturing hub, I think we need incentives because of various disadvantages we have in our country in terms of interest cost, power cost, other things. So you need to have to bring global manufacturing here, and that's the right thing. You must have heard that particularly wonderful thing has been done in respect of manufacturing of cell telephones. So I think in all the area we look forward that will become a larger part of manufacturing hub. The foreign exchange reserves, again, we continue to have excellent reserves, 570 billion, which is good enough. If they have come down last year because of obviously major part of this reduction, I think we might be aware, is because of the valuation of the securities which they have had. But yes, there have been FIs outflow, also significant outflow, more than 20 billion. So that has changed, but still I think we are very comfortable. But still global issues are affecting India and will continue to impact. Our exports slow down because the global slowdown, and also there is an increasing protectionism now. Every country wants to, protect its own and giving more incentives to the local industries. So we are changing from, a global economy to more protected economy environment. Because of that, our trade deficit obviously has widened, which is, I think, one of the highest trade deficit which we are having presently. The capital flows became uncertain, particularly when the markets, I think while our economy is doing well, compared to other economies which were not doing well, our premium in the market has increased significantly. The other markets are valuations are far lower in terms of their P multiples, and therefore, people have thought that that's the reason people withdrew money from India. Overall, the money was withdrawn from the stock market as the interest rates went up. The exchange rate have been volatile, but again, good point to see that our devaluation or our changes in currency rate is far lower than other countries, primarily because of the high interest rate in US. Obviously, the dollar has become stronger, not that our currency has become weaker. The commodity prices have been very volatile, and that has affected our corporate sector. Even if you saw the subsidies given, the food subsidy, particularly the fertilizer subsidy increased so much because of the increased oil prices last year. But now they are stabilizing at a reasonable level. Hopefully, if they go down, that would be of advantage to India. And there was a huge disruption in the supply chain last year. Now, this is the background with which this budget was given. So I now come to the budget, that what are the positives from the budget? In short, friends, I would like to say you, in my career of now, 55 years back when I became a chartered accountant, I think this is one of the finest budget which I've seen, which has addressed in almost every area. They've gone into full details and tried to address and try to see that the growth in the country not only continues but goes up. So first and foremost, the highest ever capex, as we have noticed, 33% increase over last year, uh, and about 3.3% of the GDP, which we never had. So I think there's a big boost going to be boost to the infrastructure sector, and that will obviously, induce investments in other areas. When public expenditure is high, we have always seen that the private spending also, increases, because all the industries, basic industries like cement, steel, uh, construction, they will all get a boost when there is a higher capex. The rural demand will also increase because the government is talking public-private partnership in agriculture. There is a huge investment being made in the agriculture. I think sometimes the data doesn't show it, but I think last few years, what the government has done in respect of trying to improve the productivity of agriculture, that will obviously result in better demand from the rural. The industry will get major support. In all the areas, there has been no negative things which have been done. I think most custom duties, I won't know details, but by and large, I think the efforts has been that how can it help domestic production. Uh, the small industries, MSME sector, is a huge support being declared in the budget in terms of concessional funding, in terms of credit guarantee. Also, they were talking about 20 lakh crore credit to MSME. And I think our MSAs have started now turning around. A relief to MSAs who couldn't complete their projects. So this the government said 95% of the security project would be refunded. I think all these trends show that government is seriously concerned about the growth of MSME, and I think we'll see that. The middle class, I think, again, one of the finest budget for giving relief on the income tax at all levels. And I believe that the new scheme of taxation, I'm sure the panel experts, they are better experts in that field on the panel, and Mr. Jambu Shira and other will talk on that. But my belief is that any relief on income tax always helps not only increasing the tax revenue, but also creating more demand. And last but most important is the control on fiscal and revenue deficit. I think last year the fiscal deficit has been maintained at 6.4%. The revenue deficit, that's more heartening to see, friends. I think, revenue deficit really shows that how much money is which is coming from revenue is going to just subsidize or to support the ongoing expenditure. So only when you can reduce your revenue deficit, you can invest more in the capex. And this time, we are seeing a sharp reduction in revenue deficit coming to 2.9%, which to my mind, one of the best levels achieved. Now, what are the implications for, I'm not going into all the provisions because budget, I think, but broadly, the major things which I talked about, the market looks at, capital markets particularly looks at the fiscal deficit and the borrowings to be made by the government. Uh, Now, what is the economy going to, as mentioned, capex budget will definitely boost investments across the board. The income tax relief will boost consumption, savings, and many savings are there. Surely part of the financial savings will move into the capital markets. The very big support to the poor population in the country. In PMS, Yojana, a huge budget of 79,000 crores. I think this again helps when people have their own houses. I think it helps them to grow. The fiscal deficit I mentioned earlier, both fiscal and revenue deficit. I think this is a good budget. The market borrowings are less than 12 crores, 12 lakh crores. I think we saw that, otherwise the money available, savings available for the private sector goes down. This first time then, the borrowing level are almost at the same level as last year, not higher. And also, the budget overall will not be inflationary because the fiscal deficit, revenue deficit is less. So overall, I think very positive budget. And what it will impact, to my mind, is our GDP growth of 6%, which government is talking, I think would be overachieved. My own belief is, even because the world recession also people are talking, but I think the perhaps it's not going to be as bad as it is being perceived so far, because inflation is coming down, interest rates are coming down. So hopefully, I think we should be able to go at least 6.5% in the next year. For the corporate sector, it is good for various industries, particularly, please don't mind I think some spelling mistakes there. Infrastructure, cement, steel, many basic industries, MSME, the credit support. I think the creation of that, giving 9,000 crores for creating a credit support mechanism for SMEs, through which without collaterals, if they are able to get 1 lakh crore of credit, I think that will really go in helping them. The fintech, there is a big digital side. I think our government has done wonderfully well. We are all aware that, in many areas, like on payments, we are becoming one of the largest in the world. And government has now opened many of the digital platforms to the other countries as well. The boost in consumption will help FMCG and pharma companies. The tourism, again, there's a special provision for, developing 50. I think India has a great potential of tourism. We all know that. But we need to create infrastructure for that. And I think this special focus on tourism, this budget, is, I think, most welcome. The focus on reducing compliances and decriminalizing laws, as my previous speaker also mentioned. I think this is very important because, the criminal, at the end of the day, business salesmen, non-compliance may not be because of any criminal intent. And therefore, I think the process has been started. The government has appointed a committee of MPs to look at decriminalizing all the laws. I think I'm sure the institute must be making presentations to that committee and to the government. This is a very important area. I think if this is done, it will help create more confidence and trust of businessmen. The regulators have also been asked this time that they should get the public feedback. There again, I think as institute, we should really take it up with because I think in many areas we all as professionals know that our compliances are too much, too costlier, and also is pulling back, the entrepreneurship. So I think we need to have better regulations which do not create hurdles for the business growth. The only negative factor was the life insurance, where the provision has been made to restrict the exemption of income, which again, I think Jammu Seri and other will deal with it. But yeah, it has affected the life insurance companies for a short term. I think long term, my belief is that, delinking your investments and saving now at the stage as we are in should be independent decision based on the merits of that decision rather than taxation. So that's in that respect only I said the new tax regime I think is a good tax regime. It's good to increase the basic exemption level, bring down the effective tax rate uh, at least up to a large level. You know, we have brought it down to 25 lakhs. I think we need to increase that. A lower tax regime will always help, I think, for faster growth. The tax returns, I think you know better than me. I'm told that, you know, I think first time when we get refunds within 30 days of the filing of returns, which is great. So there's an overall advantage to almost, I think, every business to my mind. So last, I'll just talk on the capital markets. For capital markets are two parts, debt and equities. Now, debt market, you know, I think the interest rates have risen sharply about 2%, 2 to 3% in last 1.5 years. Now, my view is that, you know, they are likely to soften in this year. Our RBI is in next thing. To my mind, they may not increase interest by more than 25 basis points. In fact, there could be a case if the inflation numbers are going down, maybe case not to increase it at all. But in any case, even if RBI increases the interest rates, you have seen that the in the market, you know, on the government securities, the yields are coming down. Even yesterday, the yields had gone down as much as 10 to 12 basis points, which is a good sign. I think a lower interest, you know, regime is extremely good for growth, growth of not only equities market, but the growth of the entire economy. Only thing which we missed listening anything was nothing was said about deepening of debt markets. That is one long-standing issue in our country. Our debt markets are not developed. Hopefully, government, you know, in every budget they do announce that we'll do something. This time they didn't announce anything. So, but that is an area which needs attention of the government. As far as equities are concerned, again, you know, friends, I don't talk about individual equities or this thing. Important thing is that when interest rates go down, there's a direct link between the equity markets and interest rates. So, you know, last year, US markets fell down by 10 to 15%, primarily because the money moved out from the equity markets and went to the debt markets. And this has happened all over the world. I think this is natural. When the returns become higher on the debt, one would not like to take the risk of investing in equities. But my belief is that, you know, long term, obviously equities have given high returns so far. I think if I look at last 40 years history, for which the Sensex exists, 43 years, the index return is about 15-16%. I think so. Obviously, equity market can create wealth for people, and the lower interest regime will help people again. I think it's still in India, the awareness of equity markets is far lower. I think as professionals or fellow chartered accountants, we all understand, and I think chartered accountants have played a very important role in the equity markets. A large number of, you know, when I entered this market, there were very, you know, handful of chartered accountants who were in this business of capital markets. But now I think a large number are directly involved, many are involved indirectly. So that's great. Now, income tax reduction will again increase savings and therefore more flows to equity market. So my view is that every sector has great potential to grow, because when economy grows, every sector grows. And therefore, in order to, if you want to invest in individual equity, I think you need to look at the better companies in every sector. But yes, some sectors, because of you know, the importance being given in the budget, they may as a sector do very well. And some of the sectors which I mentioned here, infra banking, and BFC, FMCG, cement, steel, you know, so they are overall, friends, an excellent investor-friendly budget, I'll call it. And I think, you know, one of the finest budget, as I mentioned earlier. That's all in my presentation. Thanks a lot once again to the committee for inviting me. And I've shared my views on the budget. So thanks once again to all of you, sir. Back to you. Thank you.
Thank
Thanks
you,
to
Anand
you.
Rathi for your lucid explanation of the budget and its impact on capital market. Sir, as a chartered accountants, we read tax provisions, and whenever two chartered accountants talk of tax provisions, there are two interpretations, if not three. But as far as the interpretation of India's GDP growth is concerned, capital market is concerned, and the cost for investing in India is concerned, everyone is upbeat and everyone is positive about all these three factors. And your presentation fortifies this belief. So we are very happy that future belongs to India. And I'm sure that as a chartered accountant community, we are already investing in capital markets. Our thick presence is there in the capital markets. And you are, sir, one of the brand ambassadors of chartered accountants holding the flag of ICI high at capital markets. I'm sure that in days to come, almost all chartered accountant would be engaged in making investments, because on one hand, interest rates are going down, and on the other hand, capital markets are paying good returns. So chartered accountants definitely understand this. And besides for their own investment, maybe they would be advising their clients as well. So, sir, thank you for your sparing valuable time and enlightening us about the impact of this union budget on our economy and ultimately on the capital markets. Sir, thank you once again.
Thank you. Thanks, sir. I'll
Friends,
take your leave, sir, right?
yes, sir. Thank you.
Okay.
Friends, after having heard about the indirect taxes and the capital markets, now let us come back to our main forte as far as the direct taxation is concerned. In direct taxation, we have two presentations. One is on international taxation and one is on domestic taxation, where the finance bill has proposed certain changes. So let me invite Chairman of International Taxation Committee, C.A. Sanjay Kumar Agarwalji, to take up this session.
Thank you, Chitle sir, Chairman, Direct Tax Committee, for giving this opportunity. Honorable past President C.A. Nihar Jambusaria ji, and Honorable my past Chairman of the International Tax Committee, N.C. Hegde sir, and other dignitaries of the line. I'll try to set the role that what are the basic changes which have been made in either international taxes or where some foreign exchange is required to be any impact on taxation. So, see the amendment which have been made in respect in section 9 regarding the gift which has been left last year to not ordinary resident also. Then there is a anti-evasion provision in respect of 44BB and 44BBB. Similarly, the time for the TP is reduced under section 92D. Also, the definition in 5627B is also changed. Now, the non-resident is also included in that. And regarding the scope of tax deduction at lower or nil rate, earlier the section 194 LBA was not there. Now they have been brought under the reduction of nil rate or reduction rate in 197. Then tax treaty TDS benefit which are there in 196A, and excluding the NBFC from the limitation in the IFSC, and the various changes which has been made in TCS when we send the money out for education, for overseas travel, for other purposes which are covered in the liberalized scheme of the government by the RBI. We normally send the money. So now there will be impact of TCS on that. So that is also very important. Then there are certain amendments which have been made regarding the export proceeds time limit and certain tax incentive in IFSC also. So these are the changes which are being made, and I hope the past chairman of the International Tax Committee will deal in details and any questions on that will be handled by him. Thank you very much for giving me this opportunity. Today at Mumbai, we are here giving the first in-depth analysis of the changes in the finance bill. Thank you very much.
Thank you, sir. Now we request CANC Hegde to have presentation. Only as far as your queries are concerned, as was invited by CS Sanjay Kumar Agarwalji, you may post those queries in chat box so that we will capture those queries and we will pass on those queries to the faculty depending upon the time available. They will be addressed today. If not, maybe we will devise some mechanism that those queries are addressed in due course of time. Thank you, and over to you, CANC Hegde.
Thank you, Sri Chitleji, who is the chairman of the Direct Taxes Committee. Thank you to my chairman, International Tax Committee, Sanjay Agarwal, who gave you an overview of the provisions of relating to non-residents. And of course, Honorable Past President Shri Nihal Jambusaryaji, who will be taking you through provisions of the direct tax as far as they relate to the residents per se. And other council members here who are present and who are listening to the webcast, and fellow colleagues. First of all, it's a great pleasure to be addressing all of you. And as Anand Rathi ji mentioned, it is always a great pleasure to be talking to fellow professionals and colleagues as such. Now, what I will try and do, attempt is to try and take you through some of the major provisions, major changes in relation to the direct taxes as far as they impact the non-residents as such. Let me first start off by the big picture by saying that there are no real big bang changes as far as non-residents are concerned. The law is settled reasonably well. There have already been some provisions which are aimed at attempting to tax, digital tax in the past, significant economic presence, and there has been an equalization levy, etc. All that which has already been there in the statute. And I think now the tax authorities will wait for whatever is the consensus which will come in terms of the pillar 1 and pillar 2, which is a broad global consensus before bringing in some of these provisions into the Income Tax Act as such. So what are the main provisions which are applicable as far as non-residents concerned? The first one is the one in relation to the provision on gifts. As you know, any gifts in excess of the 50,000 rupees today which are received are taxable as income from other sources. In 2019, this was sought to be extended to gifts made to non-residents as well. And given that there could be an argument that these gifts really do not accrue or arise in India, because the question could, or received in India, because the question could be that if you give a gift, who's really, are they completed in India? Are they completed outside India? Who's the agency and who acts as an agent and things like that? There could be some questions around that, and that's why what was brought in was the provisions of Section 918 were amended to clearly provide that any such gift to a non-resident would be considered as income which is deemed to accrue or arise in India. Now, as you are all aware, in terms of the scope of total income, both for non-residents and for not ordinary residents, income which is deemed to accrue or arise in India is obviously taxable in their hands. And therefore, though non-residents were covered, not ordinary residents were really left out of the ambit. So in that sense, any gifts made to not ordinary residents, one could argue that this did not really accrue or arise in India. There was no provision to also deem it to accrue or arise in India, and therefore they would not be taxable. So in order to try and tax such gifts, a amendment has been made in Section 918. And as a result of that, the gifts to non-residents also would now be taxable. Moving on to the next provision, which Honorable Chairman made a mention of, was in relation to the presumptive taxation. Today, what happens is that there is presumptive taxation as available to non-residents who are engaged in oil and gas exploration and services relating to oil and gas exploration, and also those engaged in projects, civil projects of construction, and also turnkey projects as such. These are also eligible to be taxed at a presumptive tax rate, where 10% of their overall receipts are considered as profits and gains of business or profession. When these were first introduced, there was supposed to be only a presumptive flat rate of tax. However, the government probably took note of the decision of the Supreme Court, which had held in case of Sannyasi Rao, that there has to be an option for a taxpayer to be able to also produce books of accounts and a tax audit and get taxed on the actual profits as opposed to a presumptive tax rate as such. And therefore, the provisions 44BB and 44BBB also contain an option by which a taxpayer can actually produce all the books of accounts and documents and a tax audit and get be taxed at that particular rate. Now, this really provided for a kind of what you call a double dip option, which means that in a year you could opt for a presumptive tax, in a year you could opt for the normal method of assessment, which meant your losses could be really carried forward for set off for the next year. And that means in a year in which you opted for a presumptive tax rate, you could also avail of the set off of tax of losses. And this was something which, according to the government, was not really in the interest of revenue and was not fair. And therefore, by this year's finance bill amendment, it is so provided that those losses which have been carried forward will not be eligible to be set off where a person opts for the presumptive rate of taxation. Moving on to another amendment in relation to transfer pricing. This is only a small procedural amendment where today, every person who has entered into an international transaction is required to keep information and documentation as per Rule 10D of the IT rules. There is also a requirement to, as and when the assessing officer requires such information, this has to be produced within 30 days. And again, then at the discretion of the AO, this can be extended by a further period of 30 days. This, the tax department believed, was really therefore taking too much of time, because you are anyway supposed to keep those documentation as ready as per Rule 10D. There was no need to give this timeline of 30 days. So that timeline, the initial timeline, has been reduced to 10 days from 30 days. The discretion of further allowing another 30 days still continues. So which means 10 days, and then within 10 days we are not able to give, there is a discretion to extend it by another 30 days as far as the officer is concerned. And then move on to a very important amendment which has been made in the provisions of section 56(2)(7)(b). Now, this is not really 56(2)(7)(b), as you know, is in that section which relates to gifts. And as you know, this has been one section which has been amended extensively over the last 10 or 15 years. If there has been one amendment, one section which has been amended day in and day out, it has been section 56. I spoke to you about the gifts, which are pure gifts as such. The section also covers transfers which have not been at fair value, and transfers of movable property, immovable property, and everything which has been listed in the section as such. 56(2)(7)(b) also seeks to cover that a company which issues shares, and if the amount which has been issued to the investors in excess of the fair market value, then that will be taxed in the hands of the issuing company as such. Now, this was really brought in order to try and ensure that there is no unaccounted money which comes in by issue of shares at a very high premium, even though the fair market value of the share does not really justify the kind of premium as such. And this was something that is applicable today. There are certain exceptions there in the section which are allowed to certain kind of venture capital funds and certain other kind of class of investors and transactions, which the CBDT will notify as such. Another important exception that was being made was for non-resident investors. However, this particular finance bill now seeks to do away with that exception which was available to non-resident investors, and therefore any issue of shares to a non-resident investor which is in excess of the fair market value would be taxable in the hands of the resident issuing company as such. So this is something which can invite a lot of litigation. There could be shares issued, as you know, and in the present day with so much of companies in the digital space, very often it is one does not issue shares based on past historic value. There is always a future value which has to be looked at, future shares to be compared with, and therefore this can give rise to a lot of litigation. Already startups, as you know, have been suffering a lot as a result of shares being issued. There is, of course, in the provision, there is something called provisions of Section 11UA, which is the mechanism which has been prescribed by legislature in order to determine the fair market value. But sometimes 11UA may not really give you the exact fair market value. There's also a provision by which one can provide to the satisfaction of the assessing officer evidence that it is the fair market value, but as you all know, is again subject to the satisfaction of the AO, and in most cases, people are not necessarily satisfied as such. So to that extent, this is a provision which could create some amount of problem and litigation, especially for non-resident investors in a time where one is looking at FDI. This could come as a little bit of a challenge as such. Then there is another procedural amendment which is aimed at trying and ensuring that 196A, which provided for a flat 20% tax rate when payment of income was being made in respect of any units of mutual fund to a non-corporate, non-resident, or to a foreign company. Many tax treaties provide for a lower rate of tax as opposed to the 20%, and therefore it is but natural that whatever is the more beneficial rate should apply, and therefore that is accordingly, Section 96A has accordingly been amended. Moving then to another important amendment in relation to what is called as limitation of interest by a resident company or by a permanent establishment or a foreign company, Section 94B. As you know, Section 94B was brought in some time ago, and it was based on the recommendations of the BEPS, the Base Erosion and the Profit Shifting Committee of the OECD. India did not have what is called as thin capitalization rules for a very, very long time. Now, in international circles, in most jurisdictions, there is what is called as thin capitalization rules, which means that every company which borrows extensively with a view to try and reduce the profit before tax as a result of this deduction is limited to a certain extent, and beyond that particular interest limitation, that amount is not allowed as a deduction. So this is very popularly called thin capitalization. Section 94B brought in that thin capitalization. There is a mechanism by which in cases of payments exceeding 1 crore, if you pay, say, interest which is exceeding 30% of earnings before interest, taxes, etc., then that excess amount will be disallowed and will be allowed to be carried forward to be set off. So there is a limitation on the interest which is so provided. There was an exception for banking and insurance companies in the past. Now, what is also sought to be done is that exemption is now sought to be also extended to non-banking finance companies. We then move on to probably also an important amendment which will impact a lot of taxpayers and clients, high net worth individuals as well, which is increasing the rate of tax collection on sources at source in respect of remittances. Now, as you are aware that today we have a LERM scheme, the liberalized remittance scheme of the RBI, where residents are allowed to remit amounts to non-residents. That amount keeps changing. It was $200,000, $250,000 time to time, depending on the exchange rate and the need to conserve foreign exchange per se. And on the such remittances, as well as also when there is a person who sells overseas tours, your very famous overseas tour packages which have been sold today, very, very popular. And when these people receive amounts from a buyer, they are supposed to collect taxes. So similarly, an authorized dealer, when he remits amounts under the LERM scheme or the liberalized remittance management scheme, is supposed to deduct tax at source. In both these cases, both the overseas tour operator as well as in the case of an authorized dealer, today the current rate was 5% in the case of an overseas tour program operator, and for the authorized dealer it was 5% or the aggregates of amounts in excess of 7 lakh rupees. That has been extended from 5% to 20% without any kind of threshold limit. So this will impact people who are going on overseas tour packages, because there will be a requirement by the tour operator to collect tax at 20%. And of course, this will be made available when they file the return, and if there is a refund due, then that can be got back. But there will be a liquidity crunch to that extent that your that your return is filed and your refund comes back to you as such. The other aspect on any kind of remittances which are made other than education and medical treatment and for certain loans, etc., which is clearly specified in section, other than those, any remittance, a 20% collection will also hit people who are remitting these kind of amounts hard. And if you read in the papers today in the Economic Times, as well as what people have forwarded, is a statement by the Revenue Secretary that this is aimed or targeted at those kind of huge remittances which are being made outside India for purchase of property, purchase of other things, because virtually the LUMS allows you to buy anything to the extent of the $250,000. The feeling is that people are making these kind of remittances but are not filing returns. So this is an attempt to try and ensure that they file returns as such, and the 20% being a high and a stiff rate is something which will get people to then file tax returns and then claim back accordingly if their income is not up to that whatever has been the deducted amount. These are some of the main amendments in relation to non-residents as such. There is one last amendment where I'll make a mention, which is on the tax incentives to a international financial center, which is the IFSC or the gift city, as you know, which the government has been very vehemently promoting. And this was a unit in an IFSC is similar, gets concessions similar to that what an SEZ unit gets, but also with a view to encourage some of these offshore financial centers to come and locate into the IFSC or the gift city as such. There are provisions under Section 7 where a transfer by a shareholder from the interest on the original fund to a relocation of an asset being in a fund which is set up in the IFC was exempted, and that exemption was available till 31st March 2023. Now this has been extended by another 2 years, and this will be available till 31st March 2025. Also, under Section 10(4)(e) of the Income Tax Act, any income which is accrued or arisen or received by non-resident as a result of some transfer of offshore derivative instruments and ODIs, as they are called, entered into with an offshore unit which is located in an IFC, is exempt. However, there have been requests to also exempt the income which is distributed by the offshore unit, because offshore banking unit, because it is believed that it leads to double taxation as such, and the government has accepted that plea and has exempted the distribution being made on these ODIs. However, there is a provision that this amount which will be so exempt will be only limited to the amount which is chargeable, first of all, in the hands of the offshore banking unit as referred to in Section 115 AD. So these are broadly some of the major provisions which impact non-residents, international investors. With that, I would request my colleague, I will hand it over back to the chairman of the Direct Tax Committee to take this forward.
Thank you, CA NC Hegde, for your informing us what are various changes in the arena of international taxation relating to non-residents. I am sure that in days to come, again, we will have to further analyze it and maybe we can have more elucidation of these provisions. But yesterday the budget was presented, and today we had this in-depth analysis as far as those provisions are concerned. Friends, in case of domestic taxes, now there are various provisions. Those provisions may not be much for the gallery, but for the tax practitioners, there are a number of aspects which they will have to look into. And therefore, it is necessary that we understand what are various provisions relating to direct taxes. As far as cooperative societies are concerned, particularly sugar cooperatives, where they were purchasing sugarcane from the farmers which were members of the cooperative societies, and the price paid over and above the FRR was getting disallowed, and there were disputes involving crores of rupees. Eminent chartered accountant from Pune, G.S. Thorat, informed that around 25,000 crore rupees were locked up in litigation, right from CIT appeal to Supreme Court at various stages. Now, this particular finance bill has made provision, and which has eased the life of cooperative sugar cooperative societies, and maybe that amount of 25,000 crore rupees will be now decongested and available to all these cooperative societies. So this is very welcome provision, and particularly heartening for the purpose of such enterprises. Besides this, in store there are a number of provisions giving relief to individuals. As far as MSMEs are concerned, maybe there were really complaints about realization of dues, and some provisions have been made for the purpose of their quick realization in the form of disallowance. In respect of various other matters, like in procedural matters, some provisions are made. There were grievances presented by many chartered accountants and others that really CIT appeals judgments are not coming, and that congestion has continued for more than 2 years. So now administrative step has been initiated for the purpose of decongestion of such appeals. So friends, we have with us an acknowledged expert in the taxation, CA Nihar Jambusariya, who was also heading the committee of direct taxes and who had been president of ICAI. So may I now invite CA Niharji for the purpose of elucidating us the provisions relating to domestic tax.
Thank you, Chitleji, the chairman of the Direct Tax Committee, and CNC Hegdeji, an expert on international tax and also the past chairman of International Tax Committee. Friends, you will appreciate that this time, although the finance minister's speech about the direct tax related provisions was very brief, and like every time we felt that there may be very limited amendments proposed in the finance bill. But when the fine prints came and when we looked at the number of amendments, there are many. Some of them are really important and critical. Some of them are of routine nature and would only require some mention. Some of the provisions were to correct some of the amendments made in the last budget, where some consequential provisions which were required to be made, they were left out and they are covered this time. So while dealing with these provisions which are proposed, I will focus on some provisions where there are some controversies or where the Direct Tax Committee needs to represent to the government to have the appropriate corrections made to achieve the intention. We have explanatory memorandum issued like every year. And in the explanatory memorandum, the intention behind a particular amendment has been mentioned. But when you read the provision, you feel that this intention is not going to be fully achieved because the drafting is perhaps little bit defective. So let me start first with the rates of taxes. We are given the impression that if the income of a person exceeds, say, 6 lakhs of rupees or 7 lakhs of rupees, and the person opts for the new regime, probably there will be benefit. But one needs to really compare and see whether the benefit is more in opting for the new regime or the benefit is in the old regime. We have prepared a comparative chart which indicates that if your income is up to 7 lakhs, then with the rebate under Section 87A, you stand to benefit because the tax payable will be nil. But if you look at income above 7 lakhs, every individual or HUF would generally make some investments in the categories listed in Section 80C, which is required for old age and retirement age. Every individual or HUF would pay medical insurance premium. And those who are salaried would claim standard deduction, would claim exemption under Section 1013A. If you opt for the new regime, you will not get standard deduction, you will not get the exemption, you will not get deductions under Chapter 6A. And as a result, the tax liability will be calculated on income without computing these deductions and exemptions. I would advise, today I don't have that chart because we are meeting in less than 24 hours. And when there were more than 100 clauses in the bill, and we had to analyze and try to discuss as many of them as possible. But if you prepare a comparative chart, we have observed that starting from the income of 7 lakhs 50,000 till even 50 lakhs, the benefit is less in the new regime if you are going to invest up to 2 lakh 75,000. See, 1 lakh 50,000 in today's scenario, almost every individual HUF earning above 7 lakhs would invest. Everybody would have health insurance as the medical cost has gone up and one would not know what would be the contingency. At the same time, particularly salaried persons would get standard deduction of 52,500 now. So if you compute these deductions and calculate tax under the old regime, the tax is still lesser up to 50 lakhs of income. Those who do not have business income have the flexibility of shifting to old regime and new regime every year. But for a person having business income, you have the option to shift to the new regime only once. So one has to exercise this option very carefully. If you do not do that, probably in the long term, you may lose. So although there is one very unique advantage in the new regime, that the surcharge will be confined to 25%, 37% surcharge has been removed now, and therefore the maximum slab rate would be, along with surcharge, not more than 39%. In fact, in my opinion, it should be even lesser than that. But still, this is a distinct advantage. But in the rates of tax, one has to weigh whether going by the old regime is beneficial, where we have already invested, or the new regime is beneficial. So much on the rates of tax. Now, let us come to cooperative societies. They have now the option to pay tax at the rate of 22% without claiming certain deductions. And manufacturing cooperative societies will have the option of paying tax at the rate of 15% without claiming certain deductions. So I'm not dealing with cooperative rates of tax in greater detail. One can definitely compare the old rates with all deductions and the new rates without deduction and decide which rate is more beneficial. Now, let us come to some of the very important provisions. MSMEs are the priority of the government and should be the priority because in the economy of every country, in the GDP, the share of MSMEs is very significant. And in Section 43B, a very important provision is sought to be introduced, that when payment is to be made to MSME, if it is not paid within the prescribed time limit. And the prescribed time limit is where there is an agreement to pay to the MSME from the date of transaction within 45 days. If the agreement provides 30 days, within 30 days. If the agreement provides payment is required to be made within 60 days, deduction will be available on accrual basis only if the payment is made within 45 days. And if there is no agreement, deduction will be allowed on accrual basis only if the payment is made within 15 days of the date of transaction with MSME. So whenever one acquires any goods or services from MSME and the payment is to be made and one wants to claim deduction on accrual basis, the payment should be made where there is agreement within 45 days, where there is no agreement within 15 days. What happens if payment is made after this prescribed time limit? Then section 43B now seeks to provide that the deduction will be available for such payment only in the financial year, in the previous year in which the payment is actually made. Now, again, this provision is slightly different. The proviso to section 43B says that in case of other payments, if the payment is made after the end of the financial year, but before the due date for filing the return under section 139(1), then deduction will be allowed in the same previous year. But so far as payments to MSME is concerned, take an example where the financial year will end on 31st March 24 and the payment is made on 5th April 24. The deduction will be allowed for previous year 24-25, assessment year 25-26, and not for previous year 23-24, that is assessment year 24-25. Although the payment is made to MSME within the time allowed for filing the return for assessment year 24-25, deduction will be allowed only in the year of payment. So that is the strict condition introduced, and I think it is good. People will, in a more disciplined manner, make payment to MSMEs, which will help them survive and grow. Then I will just make a mention of a very minor provision, but important for those who registered for the Agnivir scheme and who were employed. Contribution to Agnivir corpus fund by Agnivir, deduction under 80 HHC will be allowed. And when payment will be made out of this fund, because there will be equal contribution by the government, the entire payment would be exempt under section 1012C. Clause 12C is being introduced to provide this exemption, which is a welcome provision. Now, Chitraleji mentioned that there are some amendments to benefit cooperative societies. So in the country, there are many cooperative societies which have grown in volume and they are doing large businesses like even corporates. Let me have passing reference to this because one should know what are these advantages. He has already mentioned that if final cane price, which is paid by a sugar cooperative to the cane grower, which is above the statutory minimum price. He has already given the volume of benefit which will go to sugar cooperatives. I'm not talking about the volume, but only the nitty-gritty, that if it is above the statutory minimum price, but it is approved by the government finally, then there is a mechanism to allow the entire amount paid as deduction. And if the approval is given later by the government, then section 155 and section 154 are sought to be amended to give the deduction by rectifying the assessment even after the time limit under the original provision of 154 is over of the 4 years. So this will be the benefit to the sugar cooperatives. If I come to the other benefit which is given to cooperative societies, Under section 194N, tax is required to be deducted at source if the cash withdrawal by cooperative, by anybody from the cooperative bank exceeds 1 crore. Now this limit is sought to be increased to 3 crores. Realizing the need for cash withdrawal by cooperatives, this limit is being increased to 3 crores. I am not discussing these provisions in greater detail because these are plain provisions, straightforward. One can understand reading the provision. Again, in section 269 SS and section 269T, the limit for obtaining cash loan and repaying cash loan is 20,000 rupees. For loan given by primary agricultural credit society or primary cooperative agricultural and rural development bank to a member, this limit is sought to be increased from 20,000 rupees to 2 lakhs, where loan is obtained by a person, by a member from these cooperative societies. He can obtain it up to 2 lakhs in cash and he can repay it up to 2 lakhs in cash, and section 269 SS and T consequences will not apply. So these are the 3 benefits in this budget to cooperative societies. Now let us come to another important entity for which special provisions are being made for last 2 years. And this is the 3rd year in which again special provisions are stepped up. You know that in section 79 last year, a provision was made to provide for relaxation to a startup for 7 years from the date of its incorporation. And this benefit was that in section 79, the original provision is that if the shareholding of a company in which public are not substantially interested changes to the voting power changes to the extent of 51%, then in the year of loss as compared to the year in which the loss was incurred, then the loss will not be allowed to be carried forward and set off. For startups, a concession was granted that if 51% of shareholding in the year of loss, incurring the loss, and in the year of set off is not the same, but if all the shareholders of the startup in the year in which loss is incurred continue to be the shareholders, although 51% of shareholding may not remain the same, the carry forward and set off will be allowed up to 7 years. Now this limit is being increased to 10 years. Up to 10 years, this set off will be allowed. After 10 years, the threshold of 51% will have to be followed. Another benefit which is being extended is deduction of 100% of the profits, which is allowed to a startup in section 80 ISE. It is allowed only if the startup commences business by 31st March 2023. Now this time limit is being extended up to 1st April 24. If a startup is incorporated by 1st April 24, it will get deduction up to 100% of profit under section 80 ISE for a period of 10 years. So this is only extension of time limit for incorporation of a startup. Then a very important provision under the capital gains tax. It was provided last year that conversion of gold into electronic gold receipt will not be regarded as transfer. But this provision was incomplete, and as I said, some provisions are being made to correct the mistakes which were there in the last finance bill or finance act. Now, the intention was to promote electronic dealing in gold, and therefore conversion of gold into electronic gold receipt and then dealing with it on electronic exchange was sought to be promoted. And conversion of gold to electronic gold receipt, we will call it EGR, was not regarded as transfer. Now it is sought to be provided that even electronic gold receipt converted into gold also will not be regarded as transfer. So conversion of gold into electronic form and electronic form to physical form will not be regarded as transfer. And now take example of a person who converted his gold into EGR and then converted EGR into gold. And then he sells this gold in the market. Then what is the period of holding for the purpose of deciding whether it is provision in section 242A which defines what is a short-term capital asset. Now clause HI is sought to be added to provide that for such gold, the period of holding will commence from the date on which the original gold was acquired. And if we put it in an example, suppose a person acquired gold in the year, say 1981, converted it into EGR, electronic receipt in the year 22-23, and reconverted EGR into physical gold in the year 23-24. Now he is selling this gold in the year 23-24. Without this newly proposed clause HI, the period of holding would be computed from the date on which EGR was converted into gold. But now with this clause, the period of holding will commence from 1981, and the person will get benefit of long-term asset and even for further investment under section 54F. So this correction was required. It was represented by many, and the correction is being carried out now through this finance bill. Then coming to the next amendment, in section 72A and section 72AA, which deal with business restructuring, provision is being made that where strategic disinvestment is being made by the government, state government, or public sector company in a public sector company or any other company, the minimum shareholding threshold of 51% under section 79 of the Income Tax Act, or in the case of a company where the government holding was already below 51%, where there is transfer of controlling interest to the buyer, this restriction of carry forward of unabsorbed loss and unabsorbed depreciation will not apply. So even if the shareholding changes, the 51% of the shareholding does not remain the same. Government holding falls below 51%, or where it was already below 51%, where the controlling interest is being transferred to another buyer, still carry forward of unabsorbed losses will be allowed to the successor entity. There will not be disallowance of the brought forward losses. They will revive and continue with the new entity. Then coming to another important amendment to facilitate deduction without difficulty. In section 35D, we know that it relates to preliminary expenses, which are allowed to be deducted subject to threshold limit over a period of 5 years. Now here, if any expenditure on feasibility on carrying out feasibility report was done through an outside agency, the deduction under 35D was allowed only if this outside agency was approved by the board. And this was causing difficulty because many times they were taking a lot of time in approving the outside agency. Many times, genuinely, although the expenditure was incurred, the board was taking very extensive time to approve. Now the requirement of seeking this approval of the board is being removed. So once a person has evidence that the expenditure on conducting feasibility report was incurred, the company will get deduction under section 35D. So this is for ease of doing and removal of difficulty. The provision is simple, but it will apply with effect from assessment year 24-25. And I may only say that I'm going little faster because provisions are many and there are many important provisions. And I think I will try to cover as many of them within the limited time as possible. Coming to another important provision, section 44AD and section 44ADA. As even Rathiji mentioned that India is the country which has got now highest number of transactions through banking channels, and to promote more and more transactions through banking channels and reduce cash transactions. Now for section 44AD, where if the turnover is up to 2 crores, one may declare 8% of turnover or 6% of turnover, depending on whether 95% of receipts and payments were through banking channel. One can declare income. Now this threshold of 2 crores is sought to be increased to 10 crores if 95% of receipts and payments are through banking channels. So up to 10 crores of rupees, one can opt for section 44AD and pay tax on 8% of turnover or 6% of turnover, or rather only 6% of turnover, because you are eligible to get limit of 10 crores only if 95% of receipts and payments are through banking channel. So then you pay tax only on 6% of your turnover and opt for 44AD. For a professional, in section 44ADA, the limit is 50 lakhs. If the gross receipts of a professional do not exceed 50 lakhs, he can pay tax on 50% of income. Whereas now this limit is sought to be increased to 75 lakhs if 95% of receipts and payments are made by the professional through banking channel. So again, the cash transactions are discouraged and transactions through banking channels are being encouraged, and 10 crores particularly in a business is a very good limit for a person for not maintaining books of accounts, not getting them audited, and opting for presumptive tax and pay tax straight at a percentage on a percentage of turnover. Then one more provision, exemption under section 1022B was being given to news agencies for a very long period. Now this exemption is sought to be removed from assessment year 24-25. Again, it is a very simple provision. Now let us come to another important provision. You know that under section 115 UA and the income to the investor from REIT and InvIT. These two categories of trusts are known as business trusts, real estate investment trust, and infrastructure investment trust, REIT and InvIT. If REIT or InvIT received any income in the form of interest, dividend, rent, or repayment of debt, and any income arising from this was distributed among the unit holders, then REIT and InvIT were treated as pass-through, and this income was taxable straight in the hands of unit holder. This continues, but it was observed, there was a lacuna in this provision. It was observed that interest, dividend, and rent was really in the form of income, whereas repayment of debt had capital element, and the entire amount received was getting exempted, was being exempted in the hands of REIT and InvIT. Now it is being provided that in the repayment of debt, it will not be treated as repayment of debt, because when a REIT or InvIT redeems any unit held by a person, the entire amount received is not a capital receipt. If investment of 1 lakh was done, on redemption, the person, the unit holder, receives more than 1 lakh. So the difference between what is received and what was invested was going tax-free. Only the interest element, dividend, and rent, when distributed, was getting taxed. On redemption of unit, the entire amount was getting tax-free. Now it is being provided by introducing provision in section 224 by adding clause 7C, and by making provision in section 56(2) by adding clause 12, that the income element in redemption of units will be chargeable to tax. So if a unit was acquired at 1 lakh, on redemption more than 1 lakh is being repaid, then the income element will be computed and the difference will be taxable as income, which was getting tax-free on the ground that it is simply repayment of the amount invested. The income element was getting tax-free up to assessment year 23-24. This provision is being made prospectively from assessment year 24-25. Then next I will take up winnings from online games. With effect from 1st July 23, a new section 194BA is being introduced. It will operate for transactions commencing from 1st July 23. So it will fall in assessment year 24-25. One has time to prepare up to 30th June 23. So in fact, let us understand what was happening. Any income from gaming was covered by section 194B for the purpose of TDS. And in section 194B, it is provided that if the winning exceeds, the income from winning exceeds 10,000 rupees, then TDS will apply. Now, in any other game which is conducted physically, from the game, whatever is earned can be computed one time. If it exceeds 10,000, TDS will apply. But in the case of online gaming, the players of the game were able to bifurcate the game into different parts by entering into the game, withdrawing, starting a new game, withdrawing, every time winning small amount below 10,000 rupees and avoiding the deduction of tax at source. And once tax is not deducted at source, there is a scope to not even declare that income, even if the total income exceeds the threshold. So now new section 194BA is being provided, where if the total winnings from online game in a financial year exceeds 10,000, then either at the time of withdrawal of income or at the time of year end, where the total credits to the account of the player exceeds 10,000. It will not be computed game wise, but if the total amount in a financial year earned by the person from the same game provider exceeds 10,000, tax will be required to be deducted. Now, again, this is a provision to curb the evasion of tax by those online game players who were splitting their games into various small parts and keeping the earning from every game below 10,000 rupees. So they will not be able to do that going forward. Coming to the next provision, the percentage of TCS is now being raised. Again, it is very simple, only the limit is being enhanced. So I'm not discussing in detail, but where the payment is to the overseas tour, for the overseas tour package, instead of 5% of the amount paid, now 20% of the amount paid will be required to be deducted. And the payments falling in any other case where the percentage of deduction in excess of 7 lakhs was 5%, now even 7 lakhs threshold limit is being removed, and the percentage of deduction, percentage of collection will be 20% instead of 5%. So this is the change, and I don't think there is any complication in this. Now let us come to a very important provision, and that is section 54 and section 54F, where the objective is to restrict the deduction up to 10 crores of rupees of long-term capital gain under section 54 and 54F. So what is proposed is, let us first take 54, there is no controversy there. But in section 54F, I think probably Direct Tax Committee will have to represent that here the intention which is being expressed in the explanatory memorandum is not getting achieved. So let us discuss this in detail. Where a person has sold one residential house and acquires another residential house, up to now, if the capital, long-term capital gain was of any amount, if a new house is purchased for that much amount, full exemption was available. Now they are setting a limit of 10 crores. So if the long-term capital gain from sale of one house is 15 crores and you invest entire 15 crore, your exemption will be restricted up to 10 crores only, commencing from assessment year 24-25. They are imposing similar limit in section 54F, but let us see what is happening. Take an example, a person has sold gold and it was a long-term capital asset. So the long-term capital gain is earned from sale of say gold. And the long-term capital gain is 10 crore. The gold was sold for 15 crore. The index cost of acquisition of gold was 5 crore. Long-term capital gain is 10 crore. Now here, the section seeks to limit the amount of investment in the new house. If a person acquires a residential house, say for 15 crores, the investment will be deemed to be only 10 crores. Now, if it is deemed to be 10 crore, under section 54F, there is a formula. The exemption to be given is long-term capital gain multiplied by the amount invested in the new asset, that is residential house, divided by the net consideration received on sale of the original asset. Now, in this example, long-term capital gain is 10 crore. the investment in new house is 15 crore, but it will be taken only at 10 crore. It will be freezed at 10 crore. Above 10 crore, the investment will be ignored. So multiplied by 10 crore, divided by 15 crore, the exemption will be just 6 crore 67 lakhs only. So if you read the language of the proviso which is being made in section 54F, the proviso reads like this: provided further that where the cost of new asset exceeds 10 crore rupees, the amount exceeding 10 crore rupees shall not be taken into account for the purpose of this subsection. It means although you may have invested 15 crore, the amount invested will be taken at 10 crore. So in section 54F, if it is taken at 10 crore, the SSC will not get exemption of 10 crore. And if you look at the intention mentioned in the explanatory memorandum, the intention of the government is to restrict exemption up to 10 crore. They are saying that our intention was to promote investment in new houses. Whereas it is found that some people take huge exemption by investing in houses in this manner, which was not the intention. Therefore, they want to restrict exemption to 10 crore. In section 54F, in many cases, the exemption will get restricted to less than 10 crore of rupees. So here we need to represent and tell the government that you amend the proviso appropriately to provide that the exemption should be restricted to 15 crore, but the investment should not be taken at just 10 crore. So this is a catch in section 54F, which we need to represent. Let us come to the next important amendment proposed, and that is special provision for taxation of capital gains in case of market-linked debentures. In the case of market-linked debentures, at present it is considered to be a debt security. And when it is redeemed, the gain is considered as long-term if it was held for more than a year, if it was listed debenture. And on that long-term capital gain, only 10% tax was payable at 10%. Now they are providing that if debenture is not a pure debt instrument, but if it is a hybrid instrument and it has got a derivative element, then a new section 50AA is sought to be introduced, under which a deeming provision is sought to be introduced, that although the debenture was held for a period exceeding the threshold of 1 year, still the gain will be regarded as short-term capital gain and it will be taxable at normal rate. In other words, the memorandum says that the government now takes market-linked debentures as securities traded, and therefore the tax should be payable at normal rate. So we have 10 more minutes in which I will cover some of the important provisions and omit those which are relatively unimportant. Now, a new provision is sought to be introduced in section 142. The government has an apprehension, or perhaps the tax department, that by undervaluing inventory, many taxpayers are taking advantage for a long period, or rather perpetual advantage is being taken by some of the traders, manufacturers who have got closing stock which is undervalued. And therefore they are introducing a provision that wherever the officer feels it appropriate, then with the permission of principal chief commissioner or chief commissioner or principal commissioner or commissioner, a cost accountant may be appointed to carry out the valuation of closing stock of an SSE engaged in business, and whatever value is determined by this valuer will be taken as the value of the inventory for the purpose of computing business income. Now, I think here also probably the institute should represent that the valuation to be done by only a cost accountant will be considered, whereas in many other provisions now there are professionally trained valuers and they are registered valuers. So instead of confining this valuation by only cost accountants, if it is extended to valuation by registered valuers, it would be better and more persons will be available to carry out the valuation. Coming to the next important provision, which is being discussed extensively, and that is a restriction in clause 10D of section 10 to the exemption given on maturity amount received by a policy holder. So far, there was a restriction that if you pay premium exceeding 10% of the capital sum assured of a life insurance policy, then exemption under section 1010D would not be available at the time of receipt of maturity amount including bonus. Whereas now what they provide is similar to the restrictions imposed on ULIP premium, where if unit linked insurance premium, if it is paid in excess of 2.5 lakhs of rupees in a year, then the amount received on maturity is not exempt. In the case of life insurance policy, now they are seeking to provide that if the premium paid annually exceeds 5 lakhs of rupees, then on maturity, the maturity sum received will not be exempt. But the sum received on maturity is reduced by the amount of premium paid to the extent it was not claimed as deduction earlier, will be treated as income. So on the premium paid of an amount exceeding 5 lakhs, if a person had claimed deduction under section 80C, say every year amounting to 1.5 lakhs, then premium paid for all these years, less amount claimed as deduction under 80C will be allowed as deduction. On the difference, tax will be payable. Now again, this provision is prospective for all policies taken on or after 1st April 23. This provision will apply. And to give effect to this provision, they are introducing clause 17D in section 224, definition of income, where amount received on maturity of insurance policy will be treated as income. They are introducing clause 13 in section 56, subsection 2, to provide that where on maturity any sum is received in respect of a policy on which premium paid exceeds 5 lakhs, it will be treated as income. Now, I was comparing this provision with the provision which was already there earlier, that if a person pays more than 10% of sum assured as premium every year, then amount received on maturity of policy will be treated as income. In respect of this taxability, there was no provision in section 224 in the definition of income. There was no provision in section 56.2. But in spite of that, exemption under 1010D was denied to a person paying more than 10% of capital sum assured as premium every year. So a question was being asked by taxpayers whether in the absence of provision in section 224, where such amount received on maturity is not treated as income, if we go by general principles of accounting, such sum would be capital sum received, and whether it can be treated as income and can be taxed. Now, insofar as premium exceeding 5 lakhs per annum is paid, they've taken enough care to provide it in the definition of income in section 56(2), so it will be treated as income. One more point which is important is that if sum is received by the legal heir after the death of a person on the policy, then nothing will be taxable. Exemption will be given to the legal heir. But if during the lifetime of the policy holder this amount is received, then subject to the deduction of premium, not claimed earlier as deduction, being allowed as deduction, the balance amount will be taxed as income.
But unfortunately, this is under other sources. And
Yeah,
they are
it
not
will be.
considered as capital gain.
Yeah, it will be under other sources. So it will be
indexation will
taxed
not
at
be
full
applicable.
rate, and indexation will not be allowed. Even it will not get the benefit of concessional rate of tax on long-term capital gain.
Or reinvestment.
Yeah, although it is investment. Now, again, I think one important provision is defining cost of acquisition. I think this is an important provision. Let us complete it. After that, we will see what time is available. You know that we cherished the decision of the Supreme Court in the case of B.C. Srinivasa Setty for long number of years, that if cost of acquisition of a capital asset cannot be determined, there cannot be any capital gain, because the entire mechanism of computation of capital gain fails if you are unable to determine the cost of acquisition of a capital asset. So in section 55, in subsection 2, it was provided earlier in subclause 1, clause B, that if tenancy right or goodwill is transferred, and if these were self acquired assets and there is no cost of acquisition, it cannot be determined, the cost of acquisition will be taken at nil, it will be deemed to be nil. But this provision was confined to only tenancy rights and goodwill, and that to goodwill of the business. It did not apply even to goodwill of profession. The government, and we were wondering why all other intangible assets were left out of the purview of this deeming provision. Now they are providing that in the case of any intangible asset which is self-generated and there is no cost of acquisition, the cost of acquisition will be deemed at nil, and accordingly the capital gain will be computed and it will be taxed. So this is another important provision introduced. They are also now, if we go to, I'll just mention in one line some of the provisions which are important. Appeals with Commissioner of Income Tax Appeals have accumulated to a level where the disposal is very slow, and the process of accumulating these appeals is increasing day by day. So now they are providing another officer, that is Joint Commissioner Appeals, and the Finance Minister declared that to start with 100 Joint Commissioner Appeals will be appointed, and they will be also able to deal with some of the appeals. And the provision says that if the order was passed by an authority below Joint Commissioner or below Additional Commissioner and without approval from Joint Commissioner or Additional Commissioner, all these appeals will lie with Joint Commissioner Appeals. So there will be speedy disposal of appeals. In other words, smaller appeals will lie with Joint Commissioner Appeals. Then there are provisions to rationalize appeals with appellate tribunals. Some of the appeals did not lie in respect of some of the penalty orders passed by commissioners, some of the orders passed by commissioners. Now they are covering all those appeals under section 253, and now it will be possible to file appeal in respect of those orders. Again, in search and seizure, assistance will be given to authorized officer in the form of some protection. Again, in business reorganization, there are some provisions being made that modified return can be filed by the successor. And very important is some time limits under section 153 are being amended. Last year, it was provided that an officer can complete assessment under 143.3 regular assessment within 9 months from the end of the relevant assessment year. And taxpayers complained that this period is too short because we provide details which officers are unable to consider, and high pitch orders are being passed. So more time needs to be given. Now they are giving 12 months time from the end of the relevant assessment year to complete regular assessments. And again, in charity trusts, many amendments are proposed in this budget, which may require a full session, and I'm sure Institute and WIRC will organize program particularly to deal with provisions related to charity trusts. There are many, and in limited time, it is very difficult to deal with all these provisions. Some of the provisions which were introduced last year and which were found to be defective, they are sought to be amended to remove the defects. So by and large, these are the provisions in domestic tax area. In TDS also, there are some provisions being made where some credits which were not available, now these will be easily available. And overall, by and large, attempt is being made to provide a good budget in tax area. But I would not say that this is a short budget. Again, it is a very lengthy budget, which taxpayers and professionals will have to understand by analyzing the provisions clause by clause, understanding what they are. And Institute may have to represent on some of the provisions where there are some anomalies still left. So let us cherish this budget to the extent it is beneficial. And I tried my best to cover as many provisions as possible. Thank you so much, Direct Tax Committee, for the opportunity given to analyze the budget and make presentation to the participants. Thank you so much.
Thank you, Nihar bhai, for your detailed analysis of provisions relating to direct taxes. Friends, as we see that there are as many as 122 clauses which are proposing changes in the Income Tax Act 1961. And we have really had two luminaries, NC Hegde informing us about the changes relating to international taxation, and CA Nihar Jambusaria detailing us on the various provisions concerning domestic taxation. He has stated that maybe clause by clause analysis we will have some another occasion. But sir, you have also dealt with elaborately these provisions, and I'm sure that that will go a long way in understanding of this particular finance bill. You have proposed certain suggestions for the purpose of consideration of Direct Taxation Committee, and we are certainly preparing this post-budget memorandum. And while preparing this post-budget memorandum, we will certainly consider the aspects that you have requested us to represent. As far as charitable institutions are concerned, in the recent past, the law has been much unsettled by the introduction of all new provisions for charitable institutions, again making this expenditure or deductions available only on cash basis. And further, it has been complicated by particularly two judgments rendered by the Supreme Court last year in case of Noble Education Society and Ahmedabad Urban Development. So this certainly requires a special seminar for the purpose of analyzing these judgments, the law, and the proposals which are contained in this particular finance bill. We will certainly take note of it. So friends, we had elaborate presentation as a quick reaction on this finance bill. We have received various queries. So we will pass on those queries to the experts, and then we will try to analyze those queries and devise a mechanism how we could come out with the response to those queries in short run. So friends, thank you for joining this particular seminar where more than about 15,000 participants have joined this webinar. And I'm sure that you must have seen the various facets of this finance union budget. Firstly, we had the provisions about GST and indirect taxes, mainly the decriminalization and certain other benevolent provisions. Then the impact of union budget on the economy and the capital market, the share market, and the investment scenario. So that will also not only benefit you for your knowledge, but also individually you can take a call on your decision for the purpose of making investment, and also advising your clients on going the way forward. And as usual, most of us are practicing in direct tax arena. So whatever, although the budget speech was short as informed by Nihar Bhai, maybe as far as amendments are concerned, there were various, as I informed, more than 100 amendments. So we will have to really study. But lastly, what he mentioned about the CIT appeals, and for past 2 years, we are really finding that our decisions are not coming. Representations were already made by the direct tax committee to the CVDT and other offices. There is capacity building commission constituted under PMO. Last month I had meeting with the capacity building commission. There again we pointed out this particular aspect, and I'm sure that as a reaction to that, now this new office of Joint Commissioner Appeals has been created, and this will certainly help in decongesting the pendency at CIT appeals. So friends, thank you all for joining. And as was mentioned at the end, that as far as clause by clause analysis is concerned, the direct tax committee has organized one more webinar, which will be held on 6th of February at 6 in the evening, and that will be addressed by a chartered accountant who practices as an advocate, Kapil Goel. So please join us once again on 6th February at 6 p.m. With that, I thank you for joining, and thank you all. Thank faculties for joining. I also request our chairman for International Taxation Committee, CA Sanjay Kumar Agarwal, to present mementos to the faculties present. And we thank Anand Ratiji and Yashwant Kasar who were there online. And certainly we will acknowledge, we would like to acknowledge their presence and participation as well. Thank you. Thank you.
I will request Chairman DTC to present a memento to NC sir.
No conflict of interest. Direct tax international. Thank you.